Imagine never worrying about a paycheck again, not because you won the lottery, but because your money quietly built you a second income while you slept. It sounds like a fantasy, but it's closer than you think. With just $50 a week, the cost of a couple takeout dinners, you can start building a portfolio designed to pay you over $10,000 a month in dividends. In this video, I'll show you and John the exact drip strategy that makes this possible. I'll show you which dividend growth stocks to target, how the snowball effect works in your favor, and in the end, I'll show you how a $50 a week habit can turn into a portfolio worth well over $1 million, paying you 5 figures a month without ever touching the principal. Stick around because the numbers at the end might genuinely surprise you. The secret sauce. 0.45 to 140. Every big financial goal needs a strategy, and John's goal is simple. Build an income stream that replaces a full-time paycheck without needing to be rich to start. The problem most people run into is thinking they need $50,000 upfront to get started. They don't. What they need is consistency, and that's where the DRIP strategy comes in. DRIP stands for Dividend Reinvestment Plan. Instead of taking your dividend payouts as cash, you automatically reinvest them into more shares. Those new shares generate their own dividends, which buy even more shares, creating a snowball that gets bigger every single quarter. How DRIP works: 140 to 3. Here's a simple example. Say John owns 100 shares of a stock priced at $50, paying a $2 per share dividend each year. At the end of year 1, he's earned $200 in dividends. Instead of cashing out, he reinvests and buys 4 more shares. Now he owns 104 shares, which means next year's dividend payout is even bigger. Year after year, this cycle compounds, and the growth starts accelerating on its own. The magic isn't just compounding, it's also dollar cost averaging. By investing $50 every single week, no matter what the market is doing, John buys more shares when prices dip and fewer when prices spike, smoothing out his average cost over time. And because it's automatic, John never has to time the market or remember to reinvest. The system works quietly in the background. Choosing the right stocks. 3 to 4.15. Not every dividend stock is built for this strategy. For a DRIP portfolio designed to scale into serious income, John focuses on dividend growth stocks, companies that don't just pay a dividend, but consistently increase it year after year, which supercharges the compounding. He looks for stocks that check these boxes: a history of raising dividends for 10+ consecutive years, manageable payout ratios so the dividend is sustainable, strong durable business models, a track record of surviving recessions without cutting the dividend. Based on these criteria, John builds a 5-stock DRIP portfolio: a healthcare leader, a consumer staples giant, a tech dividend payer, an industrial dividend grower, and a broad dividend growth ETF to anchor the portfolio. The numbers: 4.15 to 6.30. Now let's see what happens if John invests $50 every week. That's about $217 a month, or $2,600 a year, into this portfolio, with an average dividend growth rate of 9% annually and average share price appreciation of 10% per year. Year 1, John's contributions total $2,600, with his portfolio value sitting right around that same mark as dividends. Just start reinvesting. Year 10, with weekly contributions and dividend reinvestment compounding quietly in the background, John's portfolio has grown to approximately $48,000. Year 20, the snowball effect kicks into high gear. John's portfolio is now valued at roughly $196,000, and he's earning meaningful passive dividends every quarter. Year 30, this is where it gets exciting. John's portfolio has grown to an estimated $687,000, generating approximately $54,000 a year in dividends alone. That's $4,500 a month without selling a single share. Year 35, bonus milestone. If John lets the snowball keep rolling just 5 more years, his portfolio could realistically cross $1.1 million, pushing his monthly dividend income past $8,000 to $10,000 a month, depending on market conditions and reinvestment pace. Out of that total portfolio value, a huge chunk, often more than half, comes purely from reinvested dividends, not new contributions. That's the power of letting the snowball roll. Outro, CTA, 6:30 to 7. So here's the takeaway. John didn't need $50,000 to start. He needed $50 a week and the patience to let compounding do the heavy lifting. That's the real secret behind dividend investing. Small, consistent action, compounding into life-changing income. If you want to see exactly which 5 dividend growth stocks can supercharge this strategy even faster,